and welcome to this week's edition of Retire Well, brought to you by the team of Citizen Advisory Group. I'm your host, Kristen Oakley, and joining me in the studio is the owner and financial advisor, Kevin Bucher, and financial advisor, Pete Samanek. We've got a great show for you today. We're going to be talking about strategies for a decreasing interest rate environment. What are we talking about? And most importantly, what does that mean for you? Kevin, Pete, always a joy to be with both of you. How are you today?
Thank you so much. Good. Great being here.
Had us back, Kevin.
What's that?
They had us back.
Yes, absolutely. Well, hey, this is y'all's show,
That's right. Okay,
I'm very honored to be a part of it. So, well, we need to talk about what's happening right now with interest rates, because what the Federal Reserve does with interest rate policy has a significant impact on our economy. In the last several years, we've been in a much higher interest rate environment, which means one set of strategies, right? And now we're starting to see that interest rates are decreasing slightly. We know that potentially the Federal Reserve might lower them again. So we need to talk about that, because obviously it can be really confusing to know what to do when based on what's happening with interest rates. So to set up our conversation, I would love for you to share a little bit about what those two different environments actually mean.
Yeah, so, I think you look at, there's two sides to this. So one is when we see changes to the interest rates, it's affecting the borrowing rates. So when we're taking out debt, whether that's for our mortgage or a car loan or school loans, so as interest rates are high, you're paying higher and higher interest rates on that. So on one hand, we have the borrowing rates, but on the other hand, we have the savings rates. So savings rates on our CDs, savings accounts, money markets. So when interest rates are high, that's a good thing. But I think there's just a little confusion around why interest rates affect so many other moving parts of the economy, in particular the stock market and the bond markets. And that's what we'll try to peel back and uncover some today.
Right, for sure. And so with interest rates moving forward, what can we expect? I mean, we don't know what's going to happen, right? We don't have a crystal ball, but what are you all seeing right now?
Sure, and that's the important thing, right? We don't know. We don't know as much as the next person or really what the Fed's doing. And what the Fed has indicated is everything is going to be data driven, right? So they're going to wait for the data to come out. They're going to kind of see what the numbers are, and then they're going to kind of react appropriately from there. So most indications, and I think if you asked 100 people, 99 of them would anticipate that interest rates are probably going to be lower between now and possibly the end of the year. But I think looking 12 months out from now, most of the data and the indication says that interest rates will be lower than they are today.
Right. Okay. So we know that the Fed recently lowered it. What was it? Half a point, yes. Right? So how do these falling interest rates affect things like saving accounts and bank CDs?
Yeah. So what we're kind of talking about right now is what does that mean to like the fixed side of your portfolio? We're going to kind of get into what that means to the stock market side of things and your more traditional type of investments. For people that are saving and taking a little bit more risk on. But on the fixed side of your portfolio, things like CDs, money markets, some of our more principal protected, less volatile assets, we're seeing those rates starting to come down, right? I mean, we've seen some of our more favored money markets going from 5.2% down as low as 4.5% now. So that's almost a full percentage drop. So I think it's important to note that, yeah, those are less than they were 6 months ago, 12 months ago, but those aren't bad interest rates, right? We're still in a good interest rate environment. And what we're talking about today is not that we're in a low interest rate environment.
Right.
I mean, 3 years ago, we were in a low interest rate environment.
Yes.
But today we're in a decreasing interest rate environment, but it's still a strong interest rate environment.
Exactly.
It's still very good. And we don't know, I mean, for the next 5 years, is this going to be as good as it gets? We don't know, right? So those are the things we have to look at.
Yeah, and this is why you guys are always staying on top of it and kind of monitoring it to be able to adjust accordingly the strategies for your clients, right?
Yeah, and it's almost right now the week by week differences we're seeing in the CD market, the fixed annuity markets. So it is something that we have to be very cognizant of and pay very close attention to.
Right, yeah. Well, I know a lot of folks are aware that bonds and interest rates have an inverse relationship. So talk a little bit about what's happening to bond yields when interest rates are declining or decreasing rather?
Yeah, so this one may be a little trickier to explain. So I know in some conversations we've had with some of our viewers, they maybe asked for a segment where we kind of just went through key terms and definitions. So I think this is maybe a good opportunity to break down bonds just a little bit.
For sure.
And kind of talk about some of the key components of bonds and then how interest rate changes might affect that, right?
Great, yeah.
So with bonds, similar to a savings account or a CD, there's going to be some type of a fixed rate of interest called the coupon rate of how much interest that the bond is going to pay. So we have the coupon rate, but then we also, and sometimes that's called the yield, right? So that's one of the tricky things about our industry is things don't have one name, they have
multiple names that mean the same thing, right? Okay, so
Yes.
coupon rate and yield.
Yeah, so that's basically the same thing. So if I took out a bond that was paying 5% interest, that's the coupon rate, and you would also hear advisors refer to that as the yield of that bond. So that's the interest that it's paying.
Right.
But then it also has a market value, and the market value, because there's a market for bonds.
Right.
So just because I might buy a 5-year bond, for example, doesn't mean that I have to necessarily hold that bond for the whole 5-year period, because there is a market that I could sell that bond early. But generally, there's going to be some term length to the bond. That's the duration of the bond. So that could be a 1 year. It could be shorter. It could be as long as 30 years. So sometimes people buy a 30-year treasury bond, for example. So we have the term length, the duration of the bond. We have the coupon rate, which is the interest that it's paying or the yield. And then you have the market value of it, which is the perceived value on a day-to-day basis of how much the bond you're holding would be worth on the open markets. So that's a little bit of a backstory. So now how do interest rate changes play into that?
Yeah, and so as those, segueing on what you're saying there, Kevin, is interest rates are coming down, those things have an inverse relationship. You know, as interest rates are coming down, so they're coming down, the price of your bonds is actually in your portfolio that you own is typically going up, right? So interest
like a
rates coming,
seesaw.
exactly. It's exactly what it is. And that's how in our education and a lot of my training, it's been explained exactly that way. As interest rates come down, bond prices go up. You know, as interest rates are going up, the price of the bonds that you own is coming down. So there's these opportunities kind of in there that as we do see declining interest rates, right, that there's an opportunity to maybe take advantage of, okay, do we increase bond exposure? Is it now a time to get kind of out of some of these bonds at higher prices and you know, switch over to stocks and things like that, or some things that have a little bit more growth potential long term? Those are kinds of the things that we're looking at in this decreasing rate environment.
Right. So, yeah, go
Yeah,
ahead,
and
Kevin.
so what I would add, just kind of a little deeper explanation maybe of that seesaw, or I think we called it a teeter-totter in my day.
Right. Yeah.
So I think when you put it in these terms that it's a little easier to grasp that if I'm holding a bond, for example, that is a 5-year bond that's paying 3% interest, and we were in this raising interest rate environment through much of 2022-23. So if bond interest was now paying 4 or 5%, but I'm sitting on this bond that's only paying 3%, well, my 3% bond is going to be worth less. So as interest rates went up, my 3% bond had less and less value to it. Well, now we're expecting that teeter-totter to start to swing the other way because interest rates are starting to drop. So if I'm holding a newer issued bond that might be paying 4 or 5% and rates start to fall, well, my value is now worth more in the market because someone wants that higher yield that my bond is paying. So I think when you put some numbers to it, it helps maybe grasp that teeter-totter a little bit better. So it is something that you, to Pete's point, you just have to be very careful of how you're moving in and out of the bond market. And, you know, there's fund managers that are doing that, and they're doing it based on the objective of the fund, not necessarily the objectives of you, the individual consumer. And that's what we just have to be very careful of. But it is something that has to be very closely monitored. We have to pay close attention to. And there is opportunity still in bonds, but it's something we have to be careful with.
Now, how does the discussion we're having today tie into the complimentary retirement checkpoint review that you offer viewers? Because obviously, you know, it's easy to get into the weeds with all this, but it's really looking at it, what it means for each person's individual situation, right?
Yes. Do you want to take that one?
So, you know, what you have to be doing is, again, as Kevin talked about, this is a constantly evolving market. We've seen interest rates, they went up very quickly. Now they're starting to, they kind of steadied out. They're starting to come down. So you constantly have to be looking at, that's what we're offering today. We're offering a complimentary retirement checkpoint review just for callers that call in or scan that QR code there on the screen. And we constantly have to be looking at these things. Retirement is not a set it and forget it type of situation. It's something that's constantly evolving because of changing interest rate environments and things along those lines.
Right, for sure. So I know when folks have questions about this, they're going to be able to come in, review their existing situation, and see how they can take advantage of these strategies based on the current environment we're in, right?
Yeah, and just to kind of tie it all together, these changes in interest rates don't just affect the investment strategy, it affects the income strategy, and we're going to talk about that today. So that retirement checkpoint view is going to be a full review across the areas of investments, your income, taxes, insurance, and your legacy and estate plan to make sure that you have a coordinated plan and it is tailored to you, the individual, and you're navigating these changes in the most efficient way possible.
Wonderful. Well, I'm excited to continue this conversation. So much to get to today, but Kevin, Pete, thank you so much. To our viewers at home, if you would like to take advantage of this opportunity to know what you should be doing right now in today's interest rate environment, we invite you to pick up the phone and call that number on the bottom of your screen to schedule your very own complimentary retirement checkpoint review. That number to call is 866-630-1675. Or if you'd rather connect online, if you simply pull out your smartphone, you can open up that camera app, just point, click, and scan that QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Citizen Advisory Group will reach out to connect with you to schedule your complimentary meeting that way as well. We'll be back with more on Retire Well right after this.
As a youth, I spent my summer months on the construction sites with my family. I think I learned early on the value of hard work. Ultimately, though, I was led into the financial services world where I joined my brother Jeff.
We were like many other financial advisors where, it was mainly transactional, but we felt there was just more. And I started to notice that the very, very wealthy families around the country had financial advisors that provided service to them that was really unparalleled. And it was always puzzling to us, well, why can't everyday hardworking people have that same opportunity?
I think we pride ourselves on the comprehensive services that we offer, which starts with the holistic financial planning. Our logo initially was a mountain-based theme, which was meant to kind of highlight the accumulation years where you're building and saving your resources for retirement, and then the backside of the mountain where you're working your way down in the distribution or income years.
I think many people think that the financial piece is just so prevalent and the most important component, but there's just more to it than that. It's about the experiences, it's about the relationships, it's about the life that our clients are living. As we looked in the future, we said, you know what, we need a logo that tells that story. It's our family coming together with your family. It's your financial pieces coming together to have a coordinated plan. It's our community coming together to keep that social connection. All of that coming together as one, and I think this logo beautifully illustrates we build all of this together to get the most out of your retirement so that you can have the retirement that you've always dreamt of.
Welcome back to Retire Well. I'm your host, Kristen Oakley, here with both Kevin Bucher and Pete Semenek from Citizen Advisory Group, and a great conversation that we're having today all about strategies for being in a decreasing interest rate environment. And really what you all did a great job setting up, we didn't call it this, but we've been talking about what's known as interest rate risk, because interest rates can change. And we know that every type of investment out there, doesn't matter what it is, has some sort of risk associated with it. So we know that rates go up, rates can come down. Who is most significantly impacted by interest rate risk?
Yes, so I'll start by, there's a lot of risk around the areas of financial planning. So I think people are very familiar with stock market risk, there's inflation risk, there's
legislative risk,
yes,
right?
The
government can change their minds, right?
And yeah. I think we have an episode coming up where we're going to kind of drill down on some of those risks. So stay tuned for that. But as it pertains to this interest rate risk, I don't know that everyone's equally impacted by interest rate risk. So I look at Pete, for example, as someone that's in his late 30s, potentially early 40s. I'm somewhere in that range.
He doesn't know.
Yeah, Pete would not be as exposed to interest rate risk as someone that's maybe near or in retirement is. And that's because Pete is very likely has very little exposure to bonds in his investment portfolio. He's probably not the typical CD investor at his age. He's probably more invested for growth and not these fixed interest bearing accounts that are so sensitive to the interest rate risk. So the other side of that is the borrowing side. So it is more likely that at a 30-year-old or 40-year-old age that they probably are a little more subject to having some debt, whether it's their mortgage or school loans. So as interest rates start to come down a little bit, that actually helps people who are trying to acquire capital. So who's more impacted is those that are near or in retirement, because it's likely that they've made this transition to taking on less risk in their portfolio. They've moved into more of these fixed interest-bearing accounts, so they are very sensitive to these interest rate changes.
Yeah, and they're impacted in different ways, right? So, I mean, when the debt is higher, you know, folks that are taking on debt at this point, I'm talking about people that are graduating college, starting careers, starting families, and getting their
Buying
houses and things.
all that, right?
That interest rates high is bad for them. Interest rates high, good for people in that retirement red zone Kevin was talking about.
Right.
And you know, the reality is we still feel like we're in a very strong interest rate environment, which is good for retirees, and we don't know how long that window is going to last, right? We've already seen that starting to shrink a little bit and you know, over the past 6 months or so, and we just don't know. You know, we don't know, is this as good as it's going to get? Is this the best moment that you have in your retirement planning to really take some action? And we don't know.
So to that point, you made me think of, you know, what is that kind of action that folks who are more subject to this interest rate risk should be taking right now before we see interest rates continue to decrease further?
Yeah, great question. And it's really a matter of going out of those things that you've been, the tools and the vehicles you've been using to get you to this point that have allowed you to really accumulate wealth and get so much money up to this point. Do we start shifting out of that side of our portfolio over to the fixed side? And we're talking about, I mean, just changing the balance from what's going on, you know, from one side to the other. And we're talking about locking in length for the rest of your life, right? Really, is this the time that we need to start locking in some length for the rest of your retirement? Because I'll go back to the housing market. We look back 5 years ago. I don't think we know how good we had it, right? Because prices were half of what they are now. Interest rates were low. You know, if you wanted to buy a house, you're like, man, I wish I would have done that 5 to 6 years ago.
Right. You could get interest rates like 2.75%.
Well, and the prices were so low. But right now, I you know, we didn't know how good we had it. So I think we're kind of looking at this window right now thinking, we might be looking back thinking we don't know how good we had it, but we don't know either.
Right, exactly.
And there has to be some analysis of what your current holdings are compared to what your goals and objectives are, and then making sure that you're using the right vehicles to achieve those goals and objectives. So that's what it's going to take, setting down, doing some analysis of the current portfolio, and then making sure that that's aligned with what your personal needs are across the next 10 to 15 years of your financial life.
Right. Well, moving forward with this conversation of strategies for a decreasing interest rate environment, how might lower interest rates impact the stock market as we move forward?
Yeah, so there's no guarantees of this, right? So we can look back at history. So there is this expectation that when interest rates are declining, or we're in a decreasing rate environment, which is what is expected, that historically has played well for stocks. And so I think you can look at that from a couple different perspectives of why that might be. So, you know, when you're looking at companies, for example, well, when companies can access capital at lower rates through loans, well, that saves them money, and that makes companies more profitable. It also makes company maybe a little more focused on growth initiatives. So all of that is good for the stock market because companies are going to spend less to access cash to fund their businesses and continue to grow.
Yeah, and that's the whole goal, right? I mean, when we talk about decreasing interest rates, that's the entire goal, is to stimulate economic activity and growth in the economy. And you know, that's why we're in such a weird period right now, because we've seen interest rates come down, markets reacted. But, I'm sorry, when interest rates came up a few years ago when markets
Right.
reacted, but markets have just fought right through that. I mean, we're sitting at all-time highs in those things, and
Yeah.
it's a bizarre period, so we don't know how.
But go ahead, Kevin.
Yeah, so low interest rates are generally good for companies.
Right.
But they're also good for consumers.
Yeah.
So consumers have a little more flexibility to access capital. And what do we do when we have funds? We generally spend those funds, and that's
Right.
good for the economy.
Right.
So again, a low interest rate environment is kind of intended to spur on the economy and continue to push the economy and the stock markets in a positive direction. But with that being said, there's no guarantees of investing in the stock market that what happened historically is what's going to happen in this cycle. So there's the hope that low interest rates will continue to provide good economic growth, but there's no guarantee of such a thing.
Exactly. So when someone comes in to receive their complimentary retirement checkpoint review from you all, how does this conversation, what does that look like when we're talking about, okay, based on your situation, how do we take advantage of where interest rates are? Walk me through some of the questions that are going to be asked to help folks determine what to do.
Yeah, so that is a great question. So, we're spending a lot of time today talking about the investment performance of interest rates and the stock market returns. But the reality is the conversation is going to start around the retirement planning conversation. And really that conversation is going to help us determine what you want your financial future to look like. And it's not until we understand what that destination is going to look like that we can now start to pack your bags for that trip. And what I mean by packing your bags is, okay, now we look at the investment portfolio. So again, that retirement checkpoint review is so important. It's going to look at all of the areas of financial planning, starting with the retirement planning process. Then we get into the investments and the tax strategies. We're going to review the insurance package from health insurance through life insurance and home and auto insurance, and then finally make sure that you have the legacy and estate plan in place, that you've got your family protected for what you want to happen at the end of life. So we're offering a complimentary retirement checkpoint review, and there's so much involved in that. So it's a great thing to take advantage of, and I think you would find great peace of mind in just walking through this process with someone from our team.
Absolutely. Kevin, Pete, thank you so much. So again, that number to call to claim your complimentary retirement checkpoint review is 866-630-1675. Or again, you're also welcome to scan that QR code, and that will get you connected as well. We'll be back with more right after this.
Imagine not having to face your retirement with the same old corporate solutions as everyone else. In these economic times, you deserve a fresh perspective that includes a personalized retirement income plan, investment portfolio analysis, and tax map from an independent fiduciary advisor whose focus is on you. Call the number you see here to schedule your complimentary review right now.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
I'm Jeff Bucher of Citizen Advisor Group, and if you've amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. We specialize in retirement planning, tax mitigation, legacy planning, and so much more. Plan your retirement right. Call now for your own complimentary retirement review and tax analysis.
Welcome back to Retire Well. I'm Kristen Oakley here with both Kevin and Pete from Citizen Advisory Group, and we've been talking today all about strategies for a decreasing interest rate environment. And I want to go back to something that we were talking about in the last segment. We were talking about the subject of interest rate risk, and that it's really not an equal opportunity offender. Really, interest rate risk affects typically those who are retired already or nearing retirement more than those who are younger. And I'm curious, I know a lot of folks with their workplace retirement plans are invested in target date funds, those good old TDFs.
Yes.
I would assume that interest rate risk is very much prone to those accounts,
Yeah.
correct?
Yeah, and I'm not suggesting that target date funds or the retirement date funds that you might have in your 401k plan are bad. I'm not suggesting that at all. We kind of look at those as they're like the easy button that they'll kind of manage those funds tailored to you and your retirement date. The challenge with them is that it's really only evaluating that portfolio allocation around your age and your proximity to retirement. So it's not really taking into account all the things that we're talking about of the interest rate changes and how that wreaks havoc on the bonds. So in theory, the closer you get to retirement in those target date funds, they're going to start allocating a heavier and heavier portion to these bonds. And that's kind of like on default, but it is not taking into consideration these interest rate changes and how that could affect the values. So it's just something to be careful of. I'm not suggesting they're bad, but it is something you want to have reviewed, and maybe there's a better alternative out there to that traditional target date fund.
Exactly, right, because the days of set it and forget it are long gone, right? Especially in these environments where we don't know.
Just because it's easy doesn't mean it's best for you.
Correct. That's a good way to put it, for sure. Well, how should folks be reconsidering their withdrawal strategy for people who are in retirement in a decreasing interest rate environment?
Yeah. So, I mean, I'll go back to something we were talking about in the last segment, is that right now we still think it's a great interest rate environment. I mean, the time is prime to really look at, okay, do we need to reassess, or now we can kind of set what our budget's going to be, are the withdrawal strategies that we have, because again, we can lock in some length. Income, because we're in a good interest rate environment, is still very easily solved. But yeah, you do need to kind of assess your 4% withdrawal strategies and things along those lines, and what we're doing. I mean, it's a perfect time to do it, and that's one of the things we're talking about with the retirement checkpoint review. Kevin talked about retirement planning is kind of one of the first areas we're going to start. What are we trying to do?
Right.
And that's going to kind of dictate where some of the dollars are going. And it's a perfect time to evaluate that.
Well, and what I would add to that is that if you think, like is kind of indicated by the Federal Reserve and most of the expert out there, that interest rates will be lower in the short-term future, well, it would be cheaper to secure an income stream today. It'll take less of your financial resources to secure your income stream today than it will if interest rates are lower in the future. So to Pete's point, this is something you want to be proactive of and get in front of, because you can buy and secure your income stream at a lower dollar today than what it's going to cost you if rates do indeed drop.
Yeah, and for a lot of folks who maybe were in some of these products a few years back when interest rates were lower, there's a huge opportunity to almost refinance what they have going on,
Sure.
right?
Yeah, that's kind of like a refinance. We've done shows on that. But yeah, looking at when interest rates are higher than they were, you're refinancing, similar to what you would do on your debt and things like that.
For sure.
So.
Well, I think my biggest takeaway from this conversation is that there's really no substitute for sitting down in the financial planning environment and seeing how all these pieces fit together. It's going to be different for each and every person you meet with, right?
Yeah, so retirement is a journey, retirement planning is a journey, and that journey starts by picking up the phone and calling and scheduling your complimentary retirement checkpoint review so we can get you on the right track for your financial future.
Wonderful. Well, Kevin, Pete, always a joy to be with you. Thank you both, and thank you so much for joining us today. We hope you found this to be valuable and helpful. That's how it's intended each and every week. Again, that number to call is 866-630-1675. Be safe, be happy, be blessed, and we look forward to being back with you next time here on Retire Well.